Hi, I'm Fred Earnest, President and CEO of Vista Gold Corp. We trade on the NYSE-AMERICAN and the Toronto Stock Exchanges under the symbol VGZ. We're advancing the Mount Todd Gold Project, one of the largest undeveloped gold projects in Australia, and have just announced some exciting news about commencing a feasibility study to evaluate the development of Mount Todd on the scale of 15,000 tons per day, with a significant reduction in our capital costs.
Very significant reduction in your capital costs from billion down to 400 million. Talk us through the why that thinking, and I suspect most people listening to this will understand the why. But let's go to the process that you did.
Yeah. So Matt, you're aware that, and many of the viewers will be aware that we've designed Mount Todd as a very large, robust operation, 50,000 tons per day throughput, producing something on the order of 480,000 ounces of gold per year over the first half of the life of the project. But it comes with a very, 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 very large price tag. The capital costs earlier this year were estimated to be just over $1 billion to build and to commission a project of that scale. We have been talking to a lot of people, and we've been doing a fair amount of work ourselves. We completed a trade-off study, and there's some significant advantages to starting the project at a much smaller scale. We've looked at 10, 12.5, 15, and 17,500 tons per day as alternative strategies. We've selected 15,000 tons per day as the optimum throughput. And that allows us the flexibility of being able to expand the project at certain points in time in the life of the project to increase the production, coming very close to that 15,000 tons per day. And so starting out at a smaller scale, obviously I mentioned the reduction in CapEx. We're targeting about a 60% reduction in capital costs for the project. Early indications are that we can get a smaller scale project built for something in the order of, and we're targeting less than $400 million. The production at this scale is still very respectable as we look at the production over the life of our project without an expansion. We see that it varies between roughly 150 to 200,000 ounces of gold per year, making it, by any standards, a very respectable gold mine. And without an expansion, it gives it a life of over 30 years. Obviously, there's plenty of opportunity to consider expansion and increasing production and shortening the life. But we feel that designing a project that has a smaller price tag and still very reasonable production is very attractive. Now, at the same time, the other thing that we're going to do is that we're going to raise the cutoff grade in the designs for this project. And instead of a 0.35 gram per ton cutoff like we've used previously, we're anticipating that we'll be somewhere in the range of 0.45 to 0.5 grams per ton. And that's going to result in a reserve grade of something very close to 1 gram per ton. It'll result in a drop in our reserves, maybe instead of 7 million ounces at 0.77 grams per ton, we're going to be looking at something like 5 or 5.5 million ounces at a gram per ton. But we think that helps us get over a hurdle that the market sees as an impediment to commencing development of a project. And so lower CapEx, higher grade, we think that all of these things bode well for improved economics and more interest and more traction for the development of the project.
Yeah, well, I think the market looks at a sub-$100 million company and a $1 billion plus CapEx, assuming everything goes right, as a major hurdle. I think you fixed that. I think you have fixed that. Now, there's something you kind of got to give away there, which is obviously it might be slightly less efficient. It might be slightly higher AISC or all-in costs for you. What does that trade-off look like initially?
Yeah, certainly at a smaller scale, we don't get to the same economies of scale as we get at 50,000 tons a day. Another significant change in this study compared to our previous work is that we intend to include contract mining. We've already engaged in conversations with a couple of the well-known contract miners in Australia, and we'll be getting a contract mining quote from one of them. Obviously, when you have contract mining, you're trading capex on the front end for operating costs on the back end, and so our all-in sustaining costs will be higher than they were in the previous study. Previously we were sub $1,000 per ounce for all-in sustaining costs. We estimate, and it's quite honestly, it's a little early to say, but I'm guessing that we'll be somewhere in the 1,200 to 1,250 per ounce on an all-in sustaining basis, which is still a very competitive number, especially at current gold price.
Well, I think that's the main story here is what gold price has done this year, up from circa $2,000 US at the beginning of the year to where it is today. Margins have increased across the board, and some companies are kind of trying to rush to get into production. Was that part of your thinking? You didn't want to kind of miss the boat here, or was it really coming back to that? You didn't think that kind of the cost of the capital around the capex for a company of your size would have been doable?
Really, Matt, this seems to be more of a headwind that we're facing. We've seen for quite some time, for the last several years, that developer producers have been more interested in acquiring other producers rather than on development risk. And so, this is not a conscious decision on our part to rush this into construction, but rather to help others realize that the risks associated with the project, with the extensive amount of work that's been completed, like Mount Todd, are not near as high as what people initially think. The fact that we have all of the permits for the construction of the project, the EIS, the federal environmental authorization, the mine operating permit are all approved, and designing the project at a smaller scale doesn't impact the validity of those permits at all. So we're actually making this easier for someone to get their head around and look at from either a partnering point of view or perhaps a project level or even corporate level transaction. We're open to any of the above, but we're trying to make this so that people recognize that this is a project that could be built and operated and ultimately expanded and generate significant cash flow for a company of any size.
It's an interesting point you make there, because you're right. The M&A that's been happening, it's there's no new answers there. It's the same answers, just under one roof now. You're talking about the ability to kind of create new answers, but with that comes risk, as you say, and there's a lot of advanced development stories kind of stuck in limbo, waiting for some M&A transactions as they root out of it. The difficulty there is the valuations of the developers have been absolutely crushed in the last 3 years. I think. Well, do you agree with that? And two, give any explanation as to why? It seems a very different sort of paradigm we're in compared to not so long ago.
I do agree with it. I'm stunned by it in some regards, but it's something that we look at and analyze on a regular basis. And what I can say is that as of the last time we completed the analysis was the latter part of September, the end of the quarter. And at that point, we saw that senior producers, which is a pretty finite group, we're up between 90 and 100% over a 2-year period. And developers, and we look at a peer group of 14 other companies in addition to us. So we're looking at a group of 15 companies that there have been 2 that have done very well and drag the average up. But the average performance for this group of developers over the same 2-year period is that they're down 0.7%. Now Vista's up 40%, and we're in the upper quartile of this peer group. But our sector has been largely ignored in this period of time when we've seen a significant rise in the gold price. And over that same 2-year period, the price of gold was up 50%. So, we're almost keeping pace with the price of gold as a company, but many of our peers are down as much as 40 or 50% over that same 2-year period. I think that there's just been as the price of gold has risen, I think that there was the idea that ounces in the ground would increase in value. But the price of gold has risen so quickly, and it's gone higher than I think many people perhaps thought it might, that the producers have been seeking a more risk-off approach. They've been seeking to acquire cash flow at today's price to be able to take advantage of production, and they're less concerned about the pipelines. Or maybe another way to put it, Matt, would be to say that those who are successfully completing M&A transactions are solving their own pipeline challenge. And when we look at let's just use Newmont acquiring Newcrest. Newmont's production profile is now pretty stable, pretty secure for the next decade or more. But that's come at the cost of the elimination of one of the major gold producers. And that the profile, the production profile, the pipeline for that other company is now being parted out and sold. And while we look at the remaining companies, the surviving companies, we say, they've got a very strong balance sheet, strong pipeline, strong production profile. We're eliminating production capacity, or we're passing it down to others. And we're not developing new projects. We're not discovering new large deposits. And so at some point, I look at this from the point of view that we can't, as an industry, continue to produce roughly 3,000 tons of gold per year without developing some new projects and without discovering some new major deposits. And that's where while the developers have been ignored in the last couple of years, I think that there's got to be a shift, that the pendulum has got to swing the other way, and that at some point, we had a great example in the last 2 weeks. I don't remember the exact day of the announcement, but Northern Star acquiring DeGrade and the Hemi project. That's maybe that's the crack in the dam. That's the first real, producer acquiring a developer sort of transaction we've all been waiting to happen. And certainly in the Australian space, I think people are very excited about the valuations that DeGrade got. So hopefully this is the start of a new trend.
I hope so. I can sort of see, why the risks to a major or mid-tier in buying a developer, might put them off. In terms of, and it's oft quoted line about the length of development timeline going from 12 years to nearly 20 years. It doesn't help, because time is money. It doesn't get those answers in immediately. You get stringent environmental requests by various jurisdictions out there, and all sorts of social license challenges, shall we say, which again take away that kind of certainty over those answers. I can understand the why. The knock-on effect is kind of interesting. With less new answers, I guess the higher the value of the answers above the ground, it seems. But we need that first brave step, and maybe you're right. Maybe Hemi is the first step we need. And there's a lot of developers out there hoping that is the case. Now, how do you coming back to what you're doing here with this feasibility study, and making it I guess more fundable initially, and cash generative sooner. How do you set that up and wrap that up in a nice little bow for a brave mid-tier to come along and say, you know what, I think this is worth that risk?
Well, certainly, we're the team that we've selected to complete this feasibility study is in many instances a fresh set of eyes. we intentionally went to a more Australian-centric team for this feasibility study. We've done some work with GRES in the past, and very pleased with their reputation in the mining, in the Australian mining space. They're well respected for being able to design, construct, and deliver projects on time, on budget, and so that's very important to make sure we get the costs right. Mining Plus is an Australian-born mining consultancy, and so having Australians designing an Australian project makes a lot of sense to us. Certainly, the size of it. I think first of all, how do you put a bow on this? Well, the results have to be credible, and that's one of the things that we've always strived for. But even more so in this case is that within the Australian space, having Australian teams design, estimate the costs, develop the schedules. We think this is really important to to have the input of Australian engineers into how it should be built and how what equipment and how much time it's going to take, et cetera. So having a credible design, credible result, I think is the first thing. Second of all, obviously the gold price is much to our favor. We will, as we've always done, the study price, the gold price we use in our economics will likely be a little bit conservative. There will probably be some of my peers that say, "Gee, why don't you use a higher gold price?" We won't make that decision till next April or May. But right now, if I were pressed, I'd say we'll probably be in the $2,100 range for economics.
And so you're using US or Aussie there?
No, we're using US.
Good. Okay. Well, yeah, understood.
So, but even still, initial indications are that the economics of the study at this scale are going to be significantly better than they were for the 50,000 ton per day case, in part because we used an $1,800 gold price for the previous study. But so I think that credible results, attractive economics, coupled with the basis that we already have. We've already established that this is a project that's it's in a great jurisdiction. B, it's fully permitted. This is, even the Hemi project, and I'm not an expert, but I understand that they've still got some permitting milestones to achieve. That's one of the advantages of Mount Todd is that we could have lawyers draft a letter to the Department of Mines tomorrow saying we intend to commence construction and be in a position in 30 days to break ground. There's not a lot of projects that can say that when you add the fact that it's, in a great jurisdiction, and then just simply add the size. With Mount Todd having, when, like we were talking, whether ultimately we end up at 5 or 5.5 million ounces at a gram compared to the 7 million ounces that we're at today, it's still a very large project. It's robust. Quite honestly, this could be a company maker. It could be the kind of project that generates very respectable cash flow for decades and be the basis for being the source of building a very large company in and of its own by being the anchor for that growth. So I think there's a lot of things that come together with what we're trying to do with this feasibility study.
Yeah, and I think we'll get into maybe exploration upside in a second, just something like some of your press releases. But let's be clear about what your options are with this revised feasibility study. You talk about the cutoff maybe being slightly higher, and maybe it's not 7 million ounces, it's 5 million ounces, but you're working towards kind of making sure this is as efficient as possible, as optimized as possible. What are the are there going to be any new data points in the new feasibility study, or are we sticking with what you got?
Well, obviously, contract mining will be a new data point. The capital cost for the construction of a smaller plant. So one of the things changing there is the design criteria. The large scale project that we previously designed, we used design criteria that were very consistent with what a senior gold producer would design themselves, with lots of concrete retaining walls, large crushers built on concrete pedestals, etc. At a smaller scale, we're able to, well, one, we don't have the vertical distances on retaining walls, and we're looking at gabion construction. That's one thing that will help us save money. Crushers, at least the secondary and tertiary crushers, will be on structural steel instead of on concrete pedestals. And so that saves us some money and allows construction to proceed more quickly. So, this is very consistent with the way gold projects in Western Australia are built. And so we're adopting more of an Australian construction mentality in the design of the project. The other areas of the project outside of plant design and contract mining are going to be pretty much as they've already been designed, because they depend on where we're at, Northern Territory, with a lot of water, and we've got to have water treatment and some other things like that. We're having a fresh set of eyes on the tailings storage facility and tailings design to make sure that that's a pretty dynamic area. It seems that every time we have a significant failure, that the tailings design standards change, and we want to make sure that we are exceeding the Australian standards and in line with the international standards. So aside from that, now the data points are going to be pretty much the same, but it's just going to be at a scale that's more manageable to start.
Okay, then let's go to the bit which kind of intrigued to me, I have to say. I mean, you talk about that kind of phase 2 drilling that you've done, and I'm sure you've got more data coming in saying much higher grade. I know we're only talking about 6 holes, but these are between 3 and 9 grams per ton. It's a very different profile to what we're talking about here. So what one. Were you surprised to be sort of seeing that, and two, what are you going to do about it?
Yeah, you're absolutely right. I mean, what we're encountering in what we call the South Cross Lode, which is a structure that's parallel and yet displaced by several hundred meters from the Batman deposit. The historic drilling that we had, which was very shallow, and all of it was RC drilling, showed some intercepts over a 40 to 50 meter width that were very intriguing to us. And we started drilling with the idea of simply perhaps defining what might be a starter pit option to create a little bit better grade for the start of the project. However, as we drilled, and we've drilled down to more or less 150 meters below the surface, what we've discovered is that the historic RC drilling didn't paint a very good picture of the structure, the lithology, the geology of this zone. And what we see is that it's farther away from the intrusive. It's less altered, less silicified in the upper reaches. The grades in the upper part of the deposit, while they're just right at the surface, are very consistent with what we see at the Batman deposit, something in the 0.5 gram to 1 gram per ton range. But when we get below 100 meters, we've encountered things that we didn't expect, as you indicated. We have in many holes encountered vein intercepts that are much thicker than what we've ever encountered in the Batman deposit. And the Batman deposit, for those listening, this is what we call a sheeted vein system. It's a mineralized zone that's 200 to 300 meters in width, and within that 200 to 300 meters, we have very small quartz calcite sulfide veins that vary in thickness from 1 millimeter or so up to perhaps 10 centimeters. And the veins occur with such a regular spacing that there's maybe 7 to 20 veins per meter. What we're seeing in the South Cross Lode is something totally different. I mean, we might drill for 10 or 15 meters and have no veins down deeper. And then all of a sudden we encounter, like some of the results that we've already announced, 0.5 meter at 50 grams per ton, or in another hole, a full meter at almost 26 grams per ton, or in another hole on another section, 2.1 meters at 13 grams per ton. We've not encountered these kinds of thicknesses and grades in any of our drilling at Mount Todd, and so this is very interesting. It's a different setting geologically. It's a different structure, and yet it's all part of the same plumbing system. The mineralization that we're encountering is the same style of it, is the same kind of quartz, calcite, sulfide veining, but it's just thicker and it's more concentrated. And so this has some very interesting implications for some point down the future. Obviously, our geologists are right now with the drilling program completed. The drill is demobilized. They're trying to figure out the geometry and the spatial relationship, from one drill hole to the next drill hole 50 meters away. How does this all tie together? And then obviously we've got some more work to do, both up dip and down dip and trying to establish continuity and whatnot. But this is the kind of mineralization that has the potential to be mined by underground mining methods at some point in time in the future. And while it's not going to change the Mount Todd mine plans today, with more work down the road, I mean, this is the sort of thing that there potentially could be, the shallow part of this structure, there could be a small starter pit on it. But further down the road, perhaps there will be an adit that takes off from the pit wall of the Batman pit and goes over and mines these high-grade structures through various underground mining methods and provides some very high-grade additional feed to the Mount Todd operation. And so we're excited about what we've seen and what we don't understand exactly how it all ties together and what it translates to as far as tons and grade today. It's always fun to encounter new things, and perhaps this starts to open a new exploration model for us as we look at the 5.4 kilometers of mineralized structures that are north of the Batman deposit. And if that holds true, then this could be the start of something very exciting, that there could be kilometers of this style of mineralization that is untested at this point in time. So a lot of arm waving, a lot of potential blue sky.
Yeah. I'm going in my head. I'm going icing on the cake. The main prize is getting this feasibility study done because it makes money. But I know what you're saying. I'm sure your geologist's eyes lit up when those drill results came back. But like I say, it's a separate structure and same feeder system potentially. But it's something that you got to understand and deal with later. I'm interested in steady as she goes, and let's get this feasibility study out, which is super exciting.
It's always nice to have an exciting additional story that you're developing. I mean, certainly, Mount Todd resource, very attractive. That's the steady as she goes part. And this year's exploration program just provides a little bit of additional appeal to a project for potential partners or investors. Somebody who could come in and spend several $1 million a year on exploration might find this to be, just the thing that gets them over the, what else is there question. So
yeah, the sex and the sizzle. Always need a bit of that. Well, like Fred, I mean, that's a super update. It kind of feels like I definitely am walking away from this conversation going, I think you made the right move with this new feasibility study and making it more accessible for funding, and that's the key. I mean, you did say use a phrase earlier, to me, this will appeal to more people, and by that I assume you meant funders for the capex, because it's more doable. So you're far away from having those conversations, I'm sure, but you probably have some soft conversations which indicate that the market might like what you're trying to do here.
Well, certainly, there's always conversations going on, and everybody has their own view. But I think that when people look at the size of project, the potential production, the capex that we're talking, I think it to most people it feels like it really is in the sweet spot, and so I think that's very positive. The other thing about this that we've not talked about is the timing. And given the immense amount of work that we've already completed on Mount Todd, and we're not going to have to repeat metallurgical testing and things like that, our environmental work is up to date, that we expect to have this feasibility study at this scale of 15,000 tons per day wrapped up by the middle of next year. And so this is very, very timely in our minds, as well as this is something that we can deliver in a reasonable time, and we're looking forward to being at Diggers and Dealers next year to talk about it. So,
well, we'll be there. I appreciate the update. Super exciting. Just put you in a kind of rarefied air. There's not too many companies in this position looking at near term production of new ounces. So, Fred, appreciate your time. Stay in touch.
Thank you very much.